Hey everyone, welcome back to Corporate Decoder. Today we're diving into a Form 8K filing, which is like the corporate world's version of a surprise party, except instead of cake, we get financial details and strategic shifts. Let's see if it's a good surprise or something more like finding out your car's being towed. This filing is from Aspire Biopharma Holdings, and it's all about a big change, a business combination, which is basically a fancy way of saying two companies got together. Aspire Biopharma joined with a company called Power Up Acquisition Corp in a deal that will hopefully boost both of their futures. Think of it as a superhero team up, but instead of fighting crime, they are trying to make money. So, what happened on February 17th, 2025? They completed this merger. Power Up Acquisition changed its name to Aspire Biopharma Holdings. To make the deal happen, Power Up also moved its base of operations from the Cayman Islands to Delaware, which is called domestication. It's like a corporate passport change. Aspire Biopharma also did its own domestication, meaning that both companies became Delaware corporations. Then a subsidiary of Power Up merged directly into Aspire Biopharma, which meant that Aspire continued to exist but as a fully owned part of the new Aspire Biopharma Holdings. Basically, they are now under one big happy roof. What does this mean for the shareholders? The old stockholders of Aspire Biopharma now own a piece of the new company and hold what they are calling New Aspire Common Stock. Power Up's shares were converted into this new common stock as well. The ticker symbols even changed on the stock market to reflect the new company, so you can follow along if you want. Now, for something more interesting, Aspire Biopharma needed money to make this happen, so they entered into an agreement to sell some securities. So think of it as taking out a loan, but instead of a bank, they are dealing with a couple of investment groups, Cobra Alternative Capital Strategies and Target Capital X LLC. These groups bought what are called debentures, which are like bonds, but with a twist, they can be converted into company stock. And the interest on them is pretty high if Aspire fails to meet their obligations. The initial amount was $3.75 million, but more could be issued if both sides agree. Aspire sold the debentures for less than their face value. They got $3 million for debentures worth $3.75 million, an original issue discount. That means if something goes wrong, the investors can charge a penalty and increase what they are owed by a lot. These debentures also have default terms and conditions. To sweeten the deal for the investors, Aspire also gave them over 2 million shares of common stock. However, these investors can't just dump all those shares on the market at once. They are limited to selling only a small portion each day, thanks to something called a leak-out agreement. It's like slowly letting the air out of a balloon instead of popping it. To make it easier for investors to eventually sell their shares, Aspire has to file paperwork with the SEC to register those shares. This is a way of promising that all the rules are being followed and no one is hiding any secrets. Someone had to broker this deal, so Aspire hired Dawson James Securities as a placement agent, and they will get a cut of the money raised. There's also an amendment to a previous agreement with Blackstone Capital Advisors. Blackstone loaned money to Aspire before, and in return, they were supposed to get a certain number of shares. Now, that number has been adjusted to nearly 1.8 million shares because Blackstone helped provide funds to get the business combination closed and also agreed to certain arrangements under a previous agreement. To keep things stable, key people in Aspire have signed lock-up agreements. These agreements prevent them from selling their shares right away, which shows they are committed to the company's future. It's like saying, I'm not going anywhere. They also signed agreements that say they won't compete with Aspire if they leave, which protects the company's business. That way, if someone leaves the company, they can't use what they learned to start a competing business. So back to the main event, the merger is done and Aspire now has over 46 million shares of common stock out there. Now, there's a note here that because Power Up used to be basically an empty shell before the merger, there's a need to provide a bunch of information that normally would be in something called a Form 10 filing. This includes what the company does, any risks it faces, financial data, who the leaders are, how much they get paid, and who owns most of the stock. Basically, a full dump of information is required so that everyone knows what is going on. There is also a lot of legal disclaimers which are quite important. Basically, it says, hey, we're making predictions about the future, but things could change, so don't sue us if we're wrong. These risks include the ability to stay listed on the stock market, competition, managing costs, raising money, keeping key employees, and changes in laws. The document also acknowledges there may be legal problems down the line and economic and business factors. For more details on Aspire's past performance, you can check out the proxy statement and look at the sections about the financial data and management's analysis. After the merger, Craig Higginson is the CEO and Ernest Scheidemann is the CFO. There's also a board of directors with a mix of people with different backgrounds and expertise. The company needs to have a number of independent directors who aren't employees or have any conflicts of interest. The people who own the most stock in the company are Craig Higginson, Suren Ajarapu, and Lance Friedman, along with a few investment groups. There are certain past relationships that are noted that could be related to the merger or investment in the new company. As of right now, there are no ongoing legal battles. The stock and warrants now trade under the symbols ASBP and ASBPW. Don't expect any dividends anytime soon. The company plans to use any profits to grow the business. The company promises to protect its leaders from lawsuits. There's been a change in accounting firms. Markham LLP was dismissed and Bush and Associates CPA LLC was hired. With the merger, there's been a change in who controls the company. There is a new compensation plan for executives called the Omnibus Incentive Plan. The company also updated its corporate documents, including the Certificate of Incorporation and bylaws. There is a new code of ethics for everyone in the company. The merger means the company is no longer a shell company. The press release about the merger is included as an exhibit. Finally, there are the unaudited balance sheets which have been checked over by external auditors but not quite as stringently. This filing shows how the new company looks financially after combining everything. Now, what does this all mean? Aspire Biopharma has made a bold move by merging with PowerUp. The fact that they needed to take on debt to complete the merger is not the best look, but not the worst. The lockup and non-compete agreements seem to show the new company's leaders are in it to win it. Overall, it seems as if Aspire is moving in a good direction. However, keep in mind the risks. The biotech industry is volatile. Also, they are dependent on raising more money down the line, which isn't an ideal situation to be in. Based on current performance and potential growth, along with risks and rewards, a price range of $6 to $8 might be reasonable. This makes me lean towards bullish because that price range is higher than the current one, depending on when you're watching this video. If the company can actually execute on the deal and use that money wisely, it will be set. Thanks for watching. If you found this informative, be sure to subscribe, like, and comment to let me know what SEC filing you'd like me to decode next.